If you're looking for big dividends, then you are in the right place, because today we're going to compare Enbridge and Pembina Pipeline, both yielding 6+%. Stick around because you will discover there might be a great investment opportunity in both these companies at somewhat depressed prices. Small disclaimer, I do own shares of Enbridge. Enbridge operates as an energy infrastructure company, which means they take care of transporting and storing different energy sources, such as natural gas, crude oil, and renewable energy. Enbridge transports about 25% of all crude oil produced in North America. There's a lot to love about this company: its predictable income stream, their wide moat, and generous dividend increases. The business model of Enbridge is quite simple, at least on the surface. They provide the infrastructure to transport energy sources such as crude, propane, and other sources. And in turn, they are paid for the amounts that run through their infrastructure. They basically operate similar to regulated utility and pipeline business, and because of the regulated nature of their contracts, it is a low-risk business model. Across all of its businesses, Enbridge has minimal direct exposure to commodity prices. Almost all of the firm's EBITDA is generated from regulated cost of service contracts, has take or pay volume commitments, or is underpinned by fixed fee agreements. They also have toll escalators built into their contracts, which means the growth on their existing infrastructure is already secured. And as an investor, I love this kind of predictability. One of the major projects for Enbridge is the Line 3 project, which should support further growth for Enbridge. On the other hand, Enbridge faces some risk with their Line 5 pipeline, as they are in a legal battle with the state of Michigan, because the governor of Michigan wants to have the pipeline shut down for environmental reasons. Pembina Pipeline, on the other hand, has its infrastructure on the west coast of Canada and entering some parts of the US there. Just like Enbridge, Pembina acts as a toll bridge and generates a large part of its cash flow, 94%, through long-term contracts with minimum volume commitments. So this offers insulation against issues such as falling commodity prices. That is also clearly visible in this picture, showing the cash flow and dividends. One of the major growth projects of Pembina is the Prince Rupert Export Terminal. This terminal is designed to export liquefied petroleum from Canada to Asia. An opportunity they have because they are on the west coast of Canada, and increasing demand coming from Asia. Another big thing is that very recently news came out that Pembina Pipeline is acquiring Inter Pipelines, though it did not officially close yet. As we will discover, the predictable cash flows of both these companies are very favorable for those of you seeking immediate income from dividends. When we compare both these companies based on market cap to get a feel of their size, it is clear that Enbridge is the much bigger company with a market cap of roughly 80 billion against 18 billion of Pembina Pipelines currently, which would obviously change if Pembina will successfully acquire Inter Pipelines. If you buy shares of Enbridge or Pembina, you are not really buying them for the massive price appreciation, but rather for the income in the form of dividends these two companies provide. Both have appreciated for about 25% in the last year. But we can also spot opportunity here, as the share prices of both Enbridge and Pembina are still below their pre-pandemic highs. Over a 5-year time frame, Enbridge is about break-even and Pembina appreciated about 6%, so that's nothing to write home about. Over a longer time frame, it is a bit different though. Enbridge has even outperformed the S&P 500 with an almost 11% annual return, including dividends. For even comparison, since we only go back to 2010 for Pembina, Enbridge has returned 6.8% annually versus the 8.1% of Pembina over approximately the same time frame. In both cases, more than half of that is coming from the dividends. To get a grip on how volatile these stocks are, can take a look at the beta of both companies. A beta of 1 means they are just as volatile as the overall market. Above is more volatile and below 1 is less volatile. Enbridge is quite steady at 0.73, and Pembina is about as volatile as the overall market at 0.97. With a bigger market cap and less volatility due to a lower beta, Enbridge wins this first round. So what about those big dividends you was talking about? Currently, Enbridge pays $2.76 annually per share, which translates to a yield just below 7%. Pembina is not far behind with a current yield of around 6%, and they pay 1.95 in dividends. There's one difference to note though. Enbridge pays quarterly dividends, but Pembina pays monthly dividends. Payout frequency does not matter, but if you really want a monthly dividend, then Pembina might be a candidate. Where the paths start to diverge is the dividend history. For both it is a bit hard to gauge, since currency fluctuations play a role here. However, Enbridge has a dividend growth streak of 26 years and are part of the Canadian Dividend Aristocrat list, which holds all companies that have raised their dividends for at least 25 years. Pembina has paid uninterrupted dividends for 22 years, but has a dividend growth streak of only 9 years. Enbridge also has a bit of a higher dividend growth, with a dividend growth rate over the last 5 years of 11%. Pembina has a dividend growth rate of 7% over the last 5 years. The earnings payout ratios for both companies look very high at first glance. Enbridge at almost 130% and Pembina at 105%. Aye. But for pipelines it doesn't make sense to look at the earnings or free cash flow payout ratio, so instead we look at the distributable cash flow or DCF payout ratio. For Enbridge the DCF payout ratio stands at 68%, Pembina slightly lower at 64%. So how does this all translate to the dividend safety score of both companies? The dividend safety score of Enbridge is only at 57. This has to do with some risk that they face with their flagship project, the Line 3 project. Pembina has a much higher dividend safety score of 80. It is quite close, but with a higher current yield, a better dividend history and a better dividend growth rate, Enbridge wins this round. But those big dividends have to be paid from somewhere. If all is well, they are paid from the profits a company generates. If all is not well, because the company is not making enough money, that might be used to pay the dividends. I'm looking at you, Exxon. That is a big red flag for me, because then the dividend payouts are not sustainable and are hurting the long-term future of the company. So what about Enbridge and Pembina? But first a bit about me and this channel. I'm Tom from the Dividend Attitude Show, and on this channel I make in-depth videos about dividend stocks. I do dividend battles between two stocks in the same industry, like this one, top 5 videos, and I give monthly updates on my portfolio. If you want to have a say in what future content I make, be sure to subscribe, because I frequently do polls in which I ask my subscribers what they would like to see next. Back to the sales of Enbridge and Pembina. First there's sales. Dividends are not paid from the sales coming in, but without sales there are no profits. But how do Enbridge and Pembina actually generate sales? As a pipeline company, Enbridge and Pembina generate revenue from crude, gas and other liquids that run through their infrastructure, pipelines. They act as a toll bridge and often have long-term contracts with big energy players like Exxon, Chevron and Consolidated Edison. These contracts also have minimum volume commitments, meaning the energy producers have to pay at least a minimum amount of toll, no matter how much runs through the pipelines. And unlike those energy producers, their profitability is not directly tied to oil and gas prices, which makes their revenue a lot more predictable. I like that predictability. Enbridge has a nice, steady uptrending revenue overall, with an average growth rate of 11%. And the same applies to Pembina, which has a growth rate of almost 30%. Yes, there are some dips in between, because of drops in demand due to the current health crisis in 2020 and in 2015-2016 due to dropping oil demand. Because of that, there was less crude running through their pipelines. But you said they were not depending on oil and gas prices. Yes and no. Minimum volume commitments provide a safety net, but if there is less demand, then naturally there is less throughput. For comparison, the revenue of ExxonMobil dropped 34% due to a plunge in oil prices in 2015-2016. Pembina only dropped 24%, and Enbridge even less, with a drop of 10%. Although Pembina has a much higher average growth rate over the last 10 years, Enbridge has less downside in bad years overall. So Enbridge wins this round. What is also important when looking at a company is what their margins look like. So the difference between the sales they generate and the actual profits or net income. The bigger the gap between those two, the higher the margins, the more room for error a company has. Enbridge has a pretty good operating or profit margin of about 20%. But it is much lower than the 28% of Pembina, and one of their other peers, TC Energy, is even higher at about 45%. Pembina wins this round and gains a bit on Enbridge. What about those profits or net income for Enbridge and Pembina? Do they support those big dividends? Well, if I look at the net income trend of both Enbridge and Pembina in a glance, I could very quickly discard Enbridge as a potential investment. Pembina looks a bit better, but still has a big dip in 2020. Because I look for companies with growing profits or net income, and this doesn't look that good. But if I look a little further and dig into how a pipeline company like Enbridge and Pembina operate, I discovered that there's more than meets the eye. Because for pipeline companies like Enbridge and Pembina, the net income is not the best metric to look at to gauge the real performance. Pipelines are expensive to build and maintain, part of the reason why Enbridge and Pembina have such a strong competitive advantage. In order to do that, they need to borrow heavily and thus pay a lot of interest. But there's another reason why net income is not the best metric to look at. Their infrastructure, so their assets, are massive, meaning they have large depreciation deductions, bringing the net income down substantially. A better way to look at the bottom line performance or profits of Enbridge and Pembina is to look at the earnings before interest, taxes, depreciation and amortization, or EBITDA. This basically means how much cash is left over after paying the operating costs of running its business and excluding one-time charges. For Enbridge, the EBITDA profit trend looks very good with an average growth rate of 14%. Obviously a drop in 2020, but considering the circumstances that is more than fine. Pembina also looks good, but we see the same pattern as with the sales, a much bigger drop in EBITDA profit in 2020 compared to Enbridge. Because of that, you guessed it, Enbridge also wins this round. The incoming sales and generated profits are not the only way to know if those big dividends are safe or not. Another way is to look at the health of the balance sheet. In other words, how much assets and liabilities they have and if there are any risks we need to consider. One of the most important things to figure out is the amount of debt a company has, both short and long term. Because if a company cannot pay off its debt because it took out more loans than it can pay off, there's a real risk of bankruptcy. And even before that, dividends that get cut. A good way to look at the leverage or debt levels of Enbridge and Pembina is to look at the debt to EBITDA. This tells you how many years it would take Enbridge or Pembina to pay off its debt with its EBITDA profits. Pembina has a debt to EBITDA ratio of 3.46 over the next 12 months. Enbridge is a bit higher at 4.68. But this doesn't really tell us much yet, because this industry is quite capital intensive, so we can't really compare it to the general benchmark. Instead, let's take a look at some of their peers, like MPLX and TC Energy. Of their peers, Enbridge is right in the middle with a net debt to EBITDA of 4.68 over the next 12 months. Pembina has the lowest of its peers. The current and quick ratio measure how well the current assets, liquid and less liquid, cover the current liabilities. Normally, I would prefer this to be at least at 1 for both. Shockingly, both Enbridge and Pembina only have a current ratio of just above 0.5 and a quick ratio of around 0.4. But if I again take a look at their closest peers, it seems that these numbers seem to be the norm for the pipeline industry, because they're all more or less around this range. This probably has to do with the capital intensity of the industry. With a better debt to EBITDA ratio, Pembina wins this round. Do they still have a chance? Before we take a look at the valuation of both these companies, what about their future? We want to know if those big dividends are secure, right? Pembina has a few paths of growth ahead of them. They very recently announced that they will acquire the Canadian company Pipeline. This will complement their existing infrastructure and the end result will look like this. This will give Pembina growth opportunities in the hydrogen and storage of carbon. With their Prince Rupert terminal giving them an entry into Asia, there's also great growth opportunities ahead. Enbridge has several growth prospects with the improvement of their Line 3 pipeline, and they focus heavily on renewable energy and especially European offshore wind development. Both are well positioned for the long-term growth trend of ever-increasing energy demand. On the other hand, the need for more sustainable energy also has a big impact on the long-term future of both these companies. But it seems both are investing heavily into energy alternatives. Pembina expects to generate 3.2 to 3.4 billion in EBITDA profit in 2021. This would be a 42% increase compared to 2019 and a 380+% increase compared to 2020, because they had such a bad 2020. Enbridge expects a profit of 13.9 to 14.3 billion, which would be a 5% increase compared to 2019 and a 34% increase compared to 2020. So Pembina wins this round with better growth rates ahead of them. Naturally, because they are a smaller company. I bought Enbridge a bit above a 7% yield and right now it is under a 7% yield. But is it still on sale? Due to the recent uptick in price, it is not as undervalued as when I bought it. According to the dividend yield theory, it is undervalued around $34, but fair value lies around $49 based on the 5-year average yield of 5.22. Double checking this with the fair value estimate on Finbox, they have a fair value around $45. With a price around $40 now, it seems there is still some value left. Then Pembina. The dividend yield theory points to a fair value of around $36, So that would mean Pembina is currently about 10% undervalued. Double checking this on Finbox, they have a fair value estimate of about $37. The good news is that both companies seem undervalued. So if you want those big dividends, then you might want to check out Enbridge or Pembina. With slightly more upside at current prices, Enbridge wins the valuation round as well. And Enbridge is also the overall winner of this battle between two Canadian pipeline companies. Enbridge does face some risks, with the scrutiny over their Line 5 pipeline, which you need to keep in mind when you want to invest in Enbridge. Watch my thoughts on that by clicking on the video here on the right. I'm off, until next time, bye bye.